Today we will discuss financial statement analysis. And before class, we try to discuss financial statement and it mathematical practice. But today, financial statement analysis, how we can analyze our statement. So there are three main segment need to analyze of financial statement. Gradually, I try to discuss about this. There are mentioned three characteristics you have to need discuss to take a sound decision. Number one, liquidity analysis, profitability analysis, and solvency analysis. Liquidity means within a short term, you have to need to payment obligation or outstanding. This liquidity disclose or express the strongness of a company promptly to pay outstanding or obligation within short period. This is the liquidity statement. And to discuss liquidity analysis, there are some techniques or tools of liquidity statement analysis. Now I am going to another option, profitability. Characteristics of the financial statement. Profitability means capacity or skill or efficiency of a manager of a company to earn profit within short period and maximum utilization of revenue and minimization of the cost. This profitability characteristics shows this route. Another for solvency. Solvency disclose or display the survival of the company on the basis of the long term. So there are some techniques or tools to disclose how we can determine the solvency analysis and profitability analysis and tools and liquidity analysis and tools. We just try to discuss gradually one by one. Okay, to discuss the liquidity, profitability, and solvency analysis, you have to know at first the comparative analysis. Comparative analysis, this analysis may be inter-company basis, maybe industry average, maybe inter-company basis. Inter-company basis means within a company, current year, previous year, or future year. Within the company, a tools or item are need to analyze within a company and inter-company are try to analysis between two company, any item, two item or three item, but this discussion will be the two more than one company. Okay, and industry average. The industry average basis compares an item or financial relationship of a company with industry average. Financial rating service are no performed within the industry. Just average calculation, average profit, average profitable tools. Profitable tools like ROA, ROE, EPS, like this.
স্যার, আপনাকে শুনতে পাচ্ছি না স্যার।
Okay, so you have to first determine how you proceed your discussion intercompany or intercompany or average base. Then you have to select the technique, your tools, which tools you have to need and discuss. These tools and technique I gradually try to discuss. So now, this is the tools of analysis. There are three tools to analyze the financial statement data: horizontal basis and vertical basis and ratio analysis. Horizontal basis means the trend analysis. Year by year, side by side, you have to determine your figure and you use your technique and you try to analysis. And vertical means ups and down. You just try to find out your techniques ups to down, and then you try to analysis. And ratio analysis is just you try to compare between more than one items, and then you try to figure out by ratio analysis. And ratio analysis actually based on the proportion. Okay. Some example I try to show by you the horizontal analysis, the year by year, side by side. You try to show the figure and you try to get comments, negative or positive or big or small size like this, like this. Another option is the vertical analysis. Vertical analysis ups to down. You have to try to your balance or try to your outcomes by one ups to downs. Say, for example, the current asset, plant, and then intangible asset, and that you try to total figure. And like this liabilities, just ups to down, you have to try to find out your out, and then you take a decision to discuss or make your valuable comments on the basis of this your figure out. This is the in the ratio analysis tools. Ratio analysis tools actually try to the compare or relationship be between more than one items. And this ratio analysis sometimes we try to disclose by percentage as rate or simple proportion. Then you try to your valuable comments, or remark. Okay. So there are some example percentage like this way and a rate and proportion like this way are clearly try to mention here. Any one you may use or both are you may use to analyze your uh, outcomes of your company financial scenario or financial position. Now I am going to discuss gradually the some basic tools and technique of financial accounting on the basis of liquidity base. Liquidity ratio, at first you have to determine a current ratio. Current ratio is one kind of the working capital. Working capital. You just try to find out working capital, current asset minus current liabilities. This ratio indicates how much cash are available to meet up the obligation or your liabilities. And a simple formula to find out the current ratio. Current ratio is equal to current asset divided current liabilities. And if there are a standard figure of current ratio 2:1 standard figure, that's mean you have 2 taka available to pay 1 taka liabilities. This is the current ratio scenario or current ratio figure. Okay. Uh, if the below of the standard or benchmark, the current ratio, your position is a loser, low handsome financial position of your company. So current ratio is standard level 2:1. Okay. This is the current ratio. Another techniques or tools, liquidity ratio, acid test ratio. Acid test ratio indicate how much immediately you have available cash, you have available liquidity asset to meet the liabilities. And there are a simple formula to find out the acid test ratio: cash plus short-term investment plus account receivable and current, then divided current liabilities. Here ignore inventory or prepaid expense or advance expense. More immediately converted cash. Such types of tools or items considered to find out the liquidity ratio. The standard or benchmark of liquidity ratio is 1:1. That's mean you have to 1 taka asset to pay the obligation by 1 taka liabilities. If below the benchmark, your organization or your institution are not good position of financial condition or financial scenario. So this is the acid test ratio of liquidity ratio analysis. Another, account receivable turnover. Account receivable means how much you will get from your client or from your customer. That's one kind of asset. This account receivable arises from the sale by on credit or on account. If you want to credit sale, in this time arise account receivable, and account receivable turnover and need to calculate how much short time you will collected your money from your customer. That indicate by this ratio. Simple formula: account receivable turnover is equal to net cash, net credit sale divided average net account receivable. Average account receivable means beginning account receivable and ending account receivable plus then divided 2. This is the average account receivable. And net credit sale you have to find out by the formula: net credit sale is equal to net sale minus cash sales. Okay. So this ratio indicate how many time taken to collect your money from your client or customer. Here is a standard benchmark. If you are able to collect your money from customer less than 30 days, this is excellent or better. 30 to 45 days is a good, and average or acceptable 90 days, and over 90 days, your financial position, your goodwill are not good for your organization. So if you are not able to collect it within 90 days, your organization not get up with a good position or with a renown. So you have to, as soon as possible, collected your money within 90 days. If you are able to collect within 19 days, you just recover default of your organization. So this is another very good tools to analyze our liquidity ratio, because third level countries like our countries of the world are very alarming. This account receivable turnover and deferred risks are maximum. The bank are very crisis at this moment behind of this default risks, and default risks are maximum occur due to account receivable turnover. Okay, so this is the another techniques to analysis the liquidity ratio. Another tools or techniques liquidity ratio disclose inventory turnover. Inventory turnover means how many times taken to sold out your inventory. If you able to sold out your inventory within short period, your financial condition is a good. You will take a good or sound decision. So if you are not able within the standard time sold out in the market, your turnover will be not good. So inventory are sometimes will be the idle capacity, increase the idle capacity. So the more your stock, your organization movement will be stopped. So very carefully you consider this level. There are simple formula to maintain these tools and technique. Inventory turnover is equal to cost of goods sold, then average inventory. Average inventory means beginning inventory plus ending inventory divided 2. And cost of goods sold means uh, final sales before the final sales of a goods of a inventory. The total cost indicate cost of goods sold. Say for example, you want to buy 100 laptop, you set the selling price 10 lakh, but actually total cost 9 lakh. So this 9 lakh is cost of goods sold. And there are another way to find out or calculate the cost of goods sold. Cost of goods sold is equal to net purchase plus opening inventory minus closing inventory. This is a very simple formula to calculate or find out the cost of goods sold. So by this technique, you will able to identify the time or days, how many days or time they can need to sold out in market. Here are standard or benchmark within 13 days. This is a good position. If you are able to sold out your inventory within 30 days is a good, and 40 to 60 days is acceptable level, and average level below 90 days. Over 90 days are not good position. This inventory definitely arrange the loss of your organization. So this movement is not good. So this is the another important tools, the liquidity ratio analysis. Inventory turnover. Here I try to calculate the days. Days in inventory turnover divided 365 days. You will get a day. How many days are able to sold out the inventory the market. This is the another tools and techniques profitable ratio. Profitable ratio are indicate earning capacity of your organization or managerial skill. But there are some important tools. Profit margin, that's mean profit margin. There are simple formula net income divided sales. Indicate how much income generated in a period. That's indicate profit earning benchmark or good position if are able to above 20%. and 10 to 15% is average, and less than 50% is alarming to earn of your company. So you have to maintain, try to maintain above 20%. Above 20% is a good position. Another tools and techniques of profitable ratio analysis: asset turnover. Asset turnover. Asset turnover measure how efficiently a company uses its asset to generate sale, generate revenue. That's mean. So simple formula to find out the asset turnover: net sale divided average total asset. Average total asset beginning plus ending balance of total asset divided 2 is very simple formula. Another return on asset, ROA, an overall measure of profitability is return on asset. How much are able to return from your investment or from your asset, that disclosed by this analysis. The simple formula: return on asset, net income divided average total asset. Average total asset also same, beginning plus ending balance of total asset divided 2. And net income you will get easily from your income statement. So this is the very fantastic tools and technique to find out the profitability ratio, ROA, that's mean return on asset. And another, return on common stock equity, that's mean ROE, return on equity. Sometimes we try to call ROE. That's mean it measure the profitability from the common stockholder viewpoint. This ratio shows how many dollar of net income of the company earned for each dollar investment by the owner. The common formula: return on common stockholder equity, net income divided average common stock equity. Equity means here is a common stock or common share. The share those have a take decision making or right of voting to select the director. Such types of share is called equity or common stock. Another way you can determine the return on common stock equity: net income minus preferred dividend divided average common stock equity. Dividend means a portion of your earnings that's keep up or hold as a dividend. This is the dividend. And another important tools, earning per share, EPS. That means this shows per share how many capacity to earn profit or dividend. That's indicate. And there are simple formula: EPS, net income minus preferred dividend divided weighted average common share outstanding. How much common share are outstanding or on account or on credit. This is indicated by this tools and technique. Another techniques to analyze profitability: price earning ratio. The price earning ratio reflects investor assessment of company's future earning. Company future earning are different on the price earning ratio. Price earning ratio is common formula: market price per share and earning per share. Just depend on market condition, market environment. That's depend this price earning ratio. Another tools and techniques of profitable ratio analysis: payout ratio. The payout ratio measure the percentage of earning distributed to the form of cash dividend. Cash dividend. Earning distributed of cash dividend. How much cash dividend or how percentage of cash dividend get by a shareholder. That is indicated by this formula. Companies that have a high growth rate generally have low payout ratio because the reinvestment most of their net income into business. So payout ratio we have to maintain critically analysis because dividend and earning per share are different on this ratio. So there are simpler common formula payout ratio, cash dividend declared or common stock divided net income. Another is the solvency ratio. Solvency ratio indicate the long-term survive of a company, the how much capacity to survive over a period of time. That is indicated by this ratio. There are common formula, there common technique, debt to asset ratio, how much debt or how much asset are available to pay the debt. Total liabilities divided total asset. The lower ratio, the more equity buffer there are available to creditor. Thus, from the creditor point of view, the low ratio of debt to asset is usually describable. So low ratio is the better. Debt to asset ratio, if you will get a low figure, this is the good for your organization and you easily uh, take a sound decision about this. Another solvency ratio, time interest earned. This ratio indicate the time interest earned provide the indication of the company's ability to meet interest payment as they come due. Time interest earned use net income before income tax expense or interest expense. That's mean EBIT. EBIT and EBT that indicate by this ratio. That's mean how much tax you have to pay or how much tax you have to determine. That is depend on this ratio. So there are common formula to find out the time interest earned ratio, net income plus interest expense plus income tax expense divided interest expense. So today I am uh, trying to discuss here very core function or core characteristics of financial